Hey everybody, it's Tugni. Investing can seem super intimidating, especially when you're just starting out. You hear all these terms like stocks, bonds, mutual funds. It's enough to make your head spin, right? But here's the thing. Investing is for everyone. And it's way easier than you think, especially with all the resources available today. Welcome to the ultimate beginner's guide to investing. Whether you're saving for retirement, a dream home, or just looking to grow your wealth, today we'll break it all down step by step. Let's dive in. So, what exactly investing? In the simplest terms, it's like planting a seed for your future. Instead of leaving your money in a savings account, you're putting it to work for you. Imagine you have $100. You could leave it in your bank account, and maybe it earns you a measly dollar in interest over a year. But what if you took that $100 and invested it in a company you believe in? If that company does well, your investment grows with it. Suddenly, your $100 could turn into $110, $150, or even more over time. You're essentially buying a piece of something that has the potential to increase in value over time, whether it's a company, real estate, or something else entirely. And the best part is, you don't need to be a millionaire to get started. There are plenty of ways to begin investing with small amounts of money. The key is to start early and let the power of compound growth work its magic. Alright, so we've covered the what of investing. Now let's talk about the why. Why should you even bother? The answer is simple. To fight inflation and grow your wealth. Inflation is like a sneaky thief that slowly eats away at the value of your money over time. If your money isn't growing at a rate that outpaces inflation, you're actually losing purchasing power. By investing, your money has the potential to grow at a much faster rate than inflation. This means your hard-earned cash is not only maintaining its value, but actually increasing over time. This is how you build real wealth over the long term. The kind of wealth that can help you achieve your financial goals.
Okay, so you're ready to start investing. But where do you even begin? There are tons of different ways to invest your money, each with its own risks and potential rewards. Let's break down some of the most popular options. First up, we have, when you buy a stock, you're essentially buying a tiny piece of ownership in a company. If the company does well, the value of your stock goes up and you make money. But if the company struggles, the stock price could drop and you might lose some of your investment. Next, we have, think of bonds like loans you're giving to a company or the government. You lend them money, and they promise to pay you back with interest over a set period. Bonds are generally considered less risky than stocks because they offer a more predictable return. However, because they are less risky, they also tend to have lower returns compared to stocks. Now let's talk about, you can buy property to rent out for passive income, or you can buy, fix up and then sell for a profit. But remember, real estate requires a significant amount of capital to get started, and it's not as liquid as stocks or bonds. And finally, for all you beginners out there, we have and/or exchange-traded funds. These are like investment baskets that hold a bunch of different stocks or bonds. It's a great way to diversify your portfolio without having to pick and choose individual stocks. Plus, they're managed by professionals, so you don't need to be a financial expert to invest in them.
Chapter 4. Understanding Risk and Reward. Before you go dumping all your savings into the next hot stock tip you hear, we need to talk about risk and reward. Investing is all about finding the right balance between the two. Think of it like a seesaw. The higher you go on one side, that's the potential reward. The steeper the drop on the other side, that's the risk. Generally speaking, higher risk investments have the potential for higher returns, but they also come with a greater chance of losing money. On the flip side, lower risk investments offer more stability and are less likely to lose money. However, their potential for growth is also lower. So, how do you know what level of risk is right for you? That depends on a few factors like your investment goals, your time horizon, and your risk tolerance. For example, if you're young and saving for retirement, you have a longer time horizon, which means you can afford to take on more risk. On the other hand, if you're nearing retirement and need your money to be more secure, you'll want to stick with lower risk investments. Remember, there's no one-size-fits-all approach to investing. It's all about finding what works best for you and your financial situation.
Chapter 5. Steps to start investing. Ready to get this show on the road? Here's a step-by-step guide to get you started. What are you investing for? Is it a down payment on a house? Early retirement? Your dream vacation? Having clear goals will help you stay focused and motivated. How comfortable are you with the idea of your investments fluctuating in value? Be honest with yourself about your risk tolerance. You'll need to open a brokerage account, which is like a bank account for your investments. There are tons of great options out there, from traditional brokerage firms to online platforms. You don't need a ton of money to start investing. Many platforms let you begin with just a few bucks. The key is to just get started and develop a consistent investing habit. Investing is a marathon, not a sprint. The key to long-term success is to invest consistently over time, even if it's just a small amount each month. Remember, time is your greatest asset when it comes to investing. Chapter 6. Common mistakes to avoid. Even seasoned investors make mistakes. But let's try to sidestep some of the most common pitfalls, shall we? Trying to predict when the market is going to go up or down is like trying to predict when lightning will strike. It's nearly impossible to do consistently. Instead of trying to time the market, focus on time the market. Invest consistently over time, and you'll be better positioned to ride out any short-term market fluctuations. Don't put all your eggs in one basket. Diversifying your portfolio across different asset classes, industries, and geographies can help reduce your overall risk. When the market takes a dive, it's easy to let your emotions get the best of you. But panic selling is almost always a bad idea. Remember, investing is a long game. Stick to your plan, and don't let your emotions lead to costly mistakes. Don't just blindly invest in something because you heard about it from a friend or saw it on social media. Take the time to do your research, understand the risks involved, and make sure it aligns with your investment goals.
So there you have it, your crash course in investing. I hope you found this helpful and feel empowered to begin your own investment journey. Remember, the best time to start investing was yesterday. The second best time is today. Even small steps can make a huge difference over time. So what are you waiting for? Your future self will thank you. Thanks for watching. If you found this helpful, hit the like button and subscribe for more financial tips. And remember, your journey to financial freedom starts now. See you next time.